Close your eyes for a second and imagine this scenario one day. Your company is praised for being among the world's most sophisticated investors. A titan that employs dozens of teams, triumphs in complex markets, and manages tens of billions of dollars. The next day, or 900 million wiped out. Overnight, this isn't fiction. This is a real story, and today we're unraveling exactly why Millennium Management lost nearly 900 million in a single financial maelstrom, how it happened, what the deeper truth says about modern finance, and what it means for the future of investing. The giant in the room, what is Millennium? Before we dive into the loss itself, you need context. Millennium Management isn't just any hedge fund. It's one of the most elite, complex, and diversified investment firms on the planet. Founded by Israel Weezy, Englander in 1989, it became renowned for multi-strategy investing, hundreds of autonomous teams, lightning-fast risk analytics, and a reputation for making money in almost any market environment. Most hedge funds are specialized. They might focus on credit, bonds, or arbitrage. Millennium's philosophy was different. It would hire smart teams, give them capital, and let them trade their ideas, expecting that diversification for risk discipline tempt profit. And for years, this formula worked until a series of market moves exposed a flaw that most outsiders never saw coming. The day the music stopped, what happened? In early 2025, something extraordinary occurred. Two of Millennium's trading teams, each operating more or less independently, placed large positions based on index rebalancing strategies. Index rebalancing is a normal and even predictable strategy. When major indices adjust their components, sophisticated traders can forecast that buying or selling pressure will follow. The idea is to front-run or anticipate moves that must happen because of rules, not sentiment. In simple terms, stock X will be bought because index Y must include it. Under normal conditions, this is steady, relatively calm money. But in 2025, market dynamics warped uncomfortably fast by forces that few people were fully watching. Volatility spikes in equities, macro uncertainty from rising rates and geopolitical shifts, liquidity thinning in parts of the market, divergences between ETFs and their underlying assets. This perfect storm meant the very predictable cues these teams relied on became less predictable at scale. And when the models didn't behave as expected, the positions lost money at speeds rarely seen before. Within a very short time span, essentially overnight, the losses mounted to about 900 million. Sounds crazy, but here is what makes it even more complex. Let's unpack why nearly $1 billion in losses overnight is such a shock. Sophistication doesn't immunize against reality. Sometimes people assume that big hedge funds have secret algorithms or unbeatable insights. Not true. These teams use models, and models are always based on assumptions. If the real world diverges sufficiently from those assumptions, the models can break just as badly as retail traders' algorithms in a crash. This isn't hubris, it's math. But it's also a warning. Complex doesn't always mean safe. Liquidity was not there when it mattered. One reason losses accelerated was liquidity dried up. Imagine trying to exit a massive position during peak trading hours in a thin market. That's a bit like trying to sell a luxury yacht in a swimming pool. Nobody can buy it at a fair price because the market isn't deep enough. When Millennium's teams tried to adjust or unwind, they got hit with slippage and widening spreads, meaning every sale lost real money fast. Risk systems didn't expect this scenario. Ironically, one of Millennium's strengths was its internal risk management. But even that system found itself chasing a reality that wasn't in its training set. Most risk systems are calibrated to historical patterns. But in a world where markets are driven by factors that didn't exist a decade ago, algorithmic liquidity providers, leveraged ETFs, and fleeting retail participation, past data doesn't always predict future behavior. This wasn't a failure of diligence. It was a blind spot in how risk is modeled industry-wide. What makes this loss stand out and why everyone talked about it? A loss of 900 million in a day for most companies would make headlines. For a hedge fund like Millennium, it's rare, but it matters for several reasons. 1. It was not because of some joke stock or meme mania. This was a professional market strategy, not Reddit traders or dog memes. Skilled professionals employing rigorous quantitative techniques still got caught. That means the lesson here isn't about social media hype, it's about true financial exposure risk. 2. Most investors don't realize how interconnected the market is. When one strategy breaks, it doesn't exist in a vacuum. Other funds, trading desks, proprietary desks, and even retail platforms can amplify movements unintentionally. In 2025, markets became a fragile ecosystem, and when a predictable strategy suddenly became unpredictable, the effects rippled outward. 3. Risk was underestimated, not obvious. Before the losses, Millennium was not considered a dangerous or over-leveraged firm. On the contrary, it was so diversified it almost defined risk management. That's what made the loss such a jolt to the industry. Even the world's best risk managers can get it wrong. Did Millennium fail completely? Not at all. Here's what most people don't appreciate. Millennium did not go bankrupt. It didn't implode. It didn't go into crisis mode. It was hit, but it survived. And this survival tells us more than the loss itself. Why? Because risk infrastructure and capital buffers exist precisely for events like this. Losses happen. The question isn't whether they happen, it's how organizations absorb and adapt to them. Millennium's diversified structure, with many trading teams, strong capital reserves, and disciplined risk oversight, meant that the $900 million loss, while huge, did not threaten the firm's viability. That's extraordinary when you think about it. Most hedge funds would have folded under that pressure. Some simply don't have enough capital to survive such a drawdown. Millennium did. So what does this mean for regular people? This story isn't just for hedge fund watchers or finance nerds. It's a crack in the facade that tells us something broader. 1. Markets can change faster than most people realize. The systems that tell us historical behavior repeats aren't always reliable. When unexpected pressures hit, changing dynamics can converge to produce outsized effects. That's why diversification isn't optional, it's a necessity. 2. Sophisticated doesn't mean safe forever. Just because a strategy worked for decades doesn't mean it's future-proof. Many investors think that if a firm is smart enough, it can outsmart the market. But markets, especially modern markets, have behavioral feedback loops that even models can't predict perfectly. Losses like this remind us of that truth. 3. This affects everyone's investment environment. When major players experience losses, everyone feels it indirectly. ETFs move differently, liquidity shifts, bid-ask spreads widen, trading behavior changes. You may not be trading derivatives or running a hedge fund, but the markets you invest in, stocks, bonds, crypto, are influenced by these dynamics. But here is the real twist. While traditional financial media might frame this as a huge loss or massive mistake, what's actually more fascinating is how these events change behavior long term. This is where the real story gets interesting. Losses like this are learning events for the entire market ecosystem. They force firms to update risk frameworks, highlight vulnerabilities in models, prompt regulators to rethink rules, push investor behavior into new patterns, reinforce that markets are adaptive, not static. In other words, a loss isn't just a headline, it's a signpost for evolution in the financial world. Can this ever happen again? Absolutely. Not just to Millennium, but to any investor who assumes markets are static, predictable, or purely rational. Some of the factors that contributed to this loss, like liquidity fragility, volatility, and strategy clustering, haven't disappeared. If anything, they intensify as technology, leverage, and derivative exposure increase. Which means you don't need to be a hedge fund to be affected by these forces. The markets of tomorrow will reward those who understand risk, adaptation, and resilience far more than those who chase returns blindly. And if you are thinking, okay, but that has nothing to do with me, think again. The companies you invest in, the retirement funds you depend on, and even the innovation economy you follow all feel the ripples of events like this. A loss in a hedge fund doesn't happen in isolation. It alters market pricing across assets, liquidity for stocks and ETFs, risk premiums on investments, and ultimately, that influences what returns ordinary investors can expect tomorrow. Here is the most important takeaway. This story isn't about failure. It's about complexity, uncertainty, and the unspoken reality that the financial world, no matter how sophisticated, still operates under risk and ambiguity. Millennium didn't get hacked. It didn't make a stupid mistake. It experienced a regime change in markets, one where historical relationships broke down temporarily, and a strategy that normally works lost fast and hard. And that is one of the most important lessons any investor, casual or professional, must understand about the modern market era. Now I want to ask you, have you ever changed your investing strategy after a big headline like this? Do you think markets will become more stable or more unpredictable in the years ahead? Drop your thoughts in the comments below, because this isn't just a story about a hedge fund. It's a story about how risk, uncertainty, and human behavior shape the financial world we all live in. If you found this breakdown engaging or eye-opening, stick around, because next we're uncovering how AI is rewriting the rules of investing and why that might be even more important than a 900 million loss.